The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour, Monday, Tuesday, Wednesday, Thursday, Friday. Of course, we didn't do Tuesday. I hope everyone had a great Christmas. And we had a dusting of snow and it looked really pretty. Very cold, but really pretty. So now we're on to the last week, just about the last week of the year. December 31st, Monday, will, of course, conclude. And I've yet to figure out why they have a full day of trading, but I guess it's just to do the books. It's upsetting. That's the one day that I always feel, just wrap it up. Let's get it done, get ready, start off the new year fresh and have a shortened day. Anyway, with that in mind, we're going to look at charts today and tomorrow. We're going to look at the longer-term implications of certain aspects of the closing price in December. We will also be looking at other implications now that the buying season, and what a buying season. I realized that the sales were less than anticipated. But first of all, it went on for so long, and they squeezed out. I mean, was it Macy's? One of those had shopping until 2 a.m. They never do that, or starting at 2 a.m., whatever it is. It's just they squeezed out every single minute of the trading holiday season. So, trading comes in now when people take back their gifts to get the ones that they wanted. However, when you're looking at the retail index, we're going to take a close look at that. We're going to look at a number of things. Most importantly, what I just want to do, I'm going to run the numbers and say that the Dow, having gone to 13,100, has broken the pattern that said to me there was even a chance to make that oval formation for what I thought would be just a chance to break slightly above the old high, the 13,361 area, and that is the most recent high. And then that's the neck, and they make the head formation, and they come plowing back into the body of the oval. Having gone underneath, even if we close decisively above, it implies two things. It implies, let me just get you the chart formation that I'm looking at right here. It implies that if the Dow is to have any strength at all, we have tremendous resistance all the way now into the 13,250 to 13,365. It could still make that sudden spiral to a new high, but it's going to have to be on news that isn't just deemed to be great for the market, but sustainable. And that is going to be very difficult, is to have a sustainable move without certain factors coming together. Now, I'm looking at bonds and I'm saying, hey, let me read the numbers. The Dow's down 38 at 13,100. The S&P is down 2.5. It's lagging a little. Dow's deeper, down deeper than not much, but down deeper than the S&P. And the S&P is at 1424. The comp index is down 21 and 29.91. Steve was talking about it. Apple is pulling back here. It just hit 311.79. So much for that. I thought we would have a little bit of a trade there with the 3-point loss we just took. Did we take it? Yeah, I'm sure we did. It doesn't matter. It's a 3-point loss, which is about 0.8%. It's very minimal. Only reason I did it is that my thinking was that we had a fabulous run in Apple before we took a 12.5-point profit. I thought what I could do was nibble on a position here with a chance that there'd be another arch formation. I still think there's going to be another arch formation before the 501 level is there should be, before 501 is tested. Believe me, if Apple closes under 501, it's going to be hazardous to the health of both the Qs, that's the NASDAQ trading vehicle, QQQ Trust, and as well as to Apple itself. So let's go on. Because the Dow has broken this level, the next key support is at 12,497, which is the 200-period exponential moving average. Now, that's what I'm looking at if the Dow closes down anywhere from this level, 13,097, or lower. Reason being, it's broken key support at 13,118. If there is it has to be a spectacular reversal to be able to maintain the oval formation. Then the oval formation can extend a little bit. But so far, everything about it is not very good. There's another factor that I want to throw in here. Let me just finish the numbers. So gold is up $1.30 at 1660. Just can't do very much. I still have that major sell signal on gold. Silver's up 0.06. Now, high-grade copper is up 430 at 3.58. It's just messing around. It's just playing games within a trading range. Let me just get this so that you can see what I'm talking about. Don't want to do too many charts here. If you're looking at Tiger TV, it's the left one is always the daily, middle one is always the weekly, right one is the monthly. This is what I'm looking at here. You see the pattern that's formed. There was a rising wedge formation, peak F top in the down, it's pulled back, and that pullback says that that is on the daily a peak F, and peak F can be time and price. But I needed, I did put the down arrow in. I kind of leapt forward a bit. I should have had patience because technically I should not be putting the down arrow in until the MACD closes, the fast moving average, the green line closes under the red line. But everything about the chart pattern said, it's going to have a tough time doing anything but have a decent bounce, no more than a bounce. Maybe it'll make a new recovery high, but it was getting tougher and tougher. It's under the blue line moving average. That's the 9-period moving average. Stochastic's down to 62. Now I can go to the copper chart, HGH 113. Here we go. And copper made a peak F top just recently. Now, folks, you say, peak F top, all these letters. It's the simplest way of notating chart formations. Within the context of doing that, you can then have a whole slew of other techniques that you can add to it. But look at this. Copper made a low at on the 2nd of August at 3.3140, and then it starts peak A on the 7th of August at 3.463. Peak B, second highest peak, is 3.524 on the 23rd of August. Pulls back, holds the 9-period moving average, goes to a peak C at 3.845 on the 14th of September, and then it makes its requisite in the ChapmanWave peak D at 3.840. Pulls back sharply, makes a cup formation, pulls back, goes to a trough D, two sell modes actually, to a trough D on the 9th of November at 3.4145, and then it goes peak A, B, C, D, pulls back after having crossed the 200-period moving average, that orangey line there. It goes to E, and then F. F is the most serious peak. Look at that. F comes all the way back down. Of course, D can be as well. But when you get to an F with the technicals fading, look at this. This is very important. The MACD was turning down. The stochastic had a much lower high than it did at the peak D. Those are all signs. So what we're looking at here is that copper is holding along the 200-period moving average in the daily chart, but it hasn't broken down, but it hasn't broken up. And in the weekly chart, you'll see basically what we're looking at is an asymmetric, because there's a different angle down as there is to the top. Well, it's almost symmetric. Series of trend lines, one declining, one rising. And if copper starts to break in the next 2 weeks below 3.49, 3.40, I would say. Let me make that clearer. It's there to there. I'm going to use the body of the candle because it's really important in this particular instance. Yeah, if it goes below 3.40, it'll tackle the 3.31 level of August, the week of August the 3rd. So what it needs to do is to power above 3.7, and it needs to do it really quickly. You've got the IYT, which is the Dow Transportation Index, having done real well, stalled at that peak D top. See how important peak Ds are? That's when you have your greatest rest. That peak D there in the IYT on the 6th of November plunged from 92.38 down to the support level in the 86s. It went to 85, 83. Now it's gone peak A. I used a phantom peak. That's right. Phantom peak. So this is technically, if you're doing the ChapmanWave strictly, this is peak C. I'm using a phantom peak of two highs and a breakout. That's 88.75 and 88.76, the high of the 20th and 21st of November. It's a little bit more I don't want to call it advanced, I don't want to call it sophisticated. It's a subtlety of the ChapmanWave. It's a methodology that you can use, but only under very strict circumstances. And that gave me the tip-off to say, at that particular high on the 20th at 95.50, testing the longer-term, very strong trend lines going all the way back to May of last year, 95.57, the high of the of this year at May the 5th at 95.57. There was that beautiful cup left side, right side price time attempt at a match, failed, it came back down. So this trading range is going to be very important, because if the IYT can break into the 96.30s, nicely above the 95.50s resistance, that'll be the first decent breakout. Now, again, a question in the den, could I do Ford? Absolutely, I'll do Ford. It's a very important stock. Why is Ford and why is General Motors, why are Ford and General Motors doing so well? Why are the home builders, as I said in my report today, this is a very it's a very detailed report I give every single day on all the different aspects of the market that I'm looking at. I give all the parameters for the Dow, the S&P, the SPY, the diamonds, the TLT, the GLD, what we're looking at, the dollar, etc. But at the same time, I also introduce stocks that we might or might not have that are very important to watch. And what I said was, how come General Motors and Ford, how come we get in the second highest impactful purchase that we make in most of our lifetimes, an automobile, and the principal, which is if you do buy it, is a house. Why are they doing so well under these conditions? Because we've got a bifurcating market. We've got a market that's rotating. We've got a market that says some areas are just terrible and other areas are starting to have been improving and are really at the cusp of that improvement, because there's a chance that if they hold well in this high-level consolidation, they could go higher, like the home builders. I'm watching it really closely because some of them are becoming overbought technically on a very shorter-term basis. But why would Ford go much higher? I'm going to get to that in a moment. Let me just finish up here by saying the TLT, which is the Lehman 20-year T-bond fund, is holding well. Now, remember what I've discussed, and I've discussed this for a little while now. Whack-a-mole was the dollar for years. Every time the dollar ran, even if it ran quite high, it would still get knocked down. Why? Because I believe it is an unspoken policy of the Fed to keep the dollar low. They wanted the benefits from exports and imports. Now we've got the Fed saying, we don't care what you're thinking, but we are going to keep interest rates low. Therefore, we're going to keep the bond market at a high level consolidation as it corrects, because technically I would have a sell signal in bonds that would say, bonds, you are going way lower. But at this particular point, you've got the Fed propping it up. So I'll be back. We'll talk about Ford. Oh, we got a caller. We got Mike in New York. We're back with Mike. Dow's down to 32. S&P's down 6.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi, everyone. We are back, and this is Basil Chapman, Tiger Technicians Hour. Don't forget, today being Wednesday, we had Steve Rhodes do the first 2 hours, and I'm coming in for the 11 o'clock till 12, 12 till 1. You got Larry Pesavento, then after Larry comes in Daryl Martin, then you got Dave White, then you got Ken Shreve, and finally, right at the end of the day, you got Tom O'Brien wrapping up the day's news events and technical analysis, and gives you his analysis based on different techniques that he uses, and just fabulous shows all the way through. What we're going to be looking at right now is there was a couple of questions, and I'm going to answer the very first question. The very first question was, I had an email asking about the euro. If you don't mind, just as we're going to go to our first caller. Whoops, there's another call, but that's not the call I want, so we just get rid of that. We've got the EUR USD. I just wanted to look at the currency pair. This is a peak E that's been made at 1.330. Now, what happens is that you're looking at a breakout in the handle and cup formation, basically. And that said that the level of 1.317 that was made in September was pierced. Now the support, that whole area of 3.30 to 3.31, that's going to be key support. Most importantly is that the MACD is kind of flat and the stochastic is 76 1%. So we've got to look at this as if to say, all right, you tell us, because if you break above 1.33076, that starts leg F/B, and that's in the euro dollar. And I just want you to also mention the JPY, USD JPY, because that has soared, that has broken out the US dollar, Japanese yen currency pair. Now, I'm sure that Larry's going to be looking at all of these in much greater detail, but what I'm saying is that I've got this as a leg E, a spectacular move, but it is bumpy. You remember, all for the last week or so, I've been saying the target I have, I'm not sure when it'll be able to achieve that, is that yellow line, the 200-period exponential moving average, which is at about 85.68. And right now it's at 85.62, having hit 85.72. It has done its job in this particular move. The MACD in the weekly is still very strong, and the monthly is still strong. So this looks to me like it looks to me like the cup and ladle ChapmanWave breakout in the USD JPY currency pair is a very strong breakout, and it turns the 82.76 area in the weekly chart, the 9-period moving average, into tremendous support. I just need to, I know I'm going to forget, you've got just until Monday in which to buy my CD introducing the ChapmanWave methodology for half price. I throw in my opening call, a month free. Basically, I'm giving you $4 to try it out. I'll talk about it a little later on, but we've got callers waiting quite a while. So let me go to Mike in New York. Hi, Mike. How are you doing?
Good. How you doing?
Very well, thank you.
You have a look at Royal Caribbean?
Okay, now I had both this one and CCL, which is Caribbean Cruise, notated beautifully. I'm not going to go into the reason why it's not showing up right now, but it's not. It takes me just a moment to put in the notation. The monthly chart made a peak D-top. And I'm going to forget this as well, but I just heard a snippet with Steve, and it was great. He spoke about round numbers and a peak G. Before I forget, this missed a round number by 1 penny at $49.99 in January of 2011. So I'm just going to throw in Herbalife. And he's absolutely correct. For those of you who want to know, I talk about round numbers. They're very important to my work in potential tops and bottoms. This one is a doji at peak G in the Herbalife monthly chart, and then it made this is a beautiful A to B equals C to D down. I got 2152 as a potential for this stock moving along. I just want to go back. I needed to bring that in because of the different methodologies I use in the ChapmanWave, the book, the CD introducing the ChapmanWave methodology. Now let's go back to RCL. Now the question is, how come Royal Caribbean Cruises, RCL, trading at 33.51 right now, was able to do so well when we were under pressure in the greatest recession since the Great Depression, which I've disagreed with vociferously ever since it was stated. These are people that evidently never experienced 1972 to 73, the whole 1960, they couldn't get through 1,000 for 12 years or something. So this is politician talk as usual, big exaggeration over nothing. Not that it was nothing for the housing market or the mortgage or the banks. I'm just saying that was not. The 1991-92 bank debacle was horrible. So that gave me a chance now quickly to do the notation, to renotate Royal Caribbean Cruise Lines. I have to tell you, I think that this is making a peak E-top of significance in the weekly chart. I'm going to just finish up doing the daily chart, and I'll be right back with you, Mike, if you don't mind. You're looking to short. Am I correct? Okay, I'll be right back with Mike in New York and Mike in Ormond Beach, and we'll talk about the Dow as well.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi, folks. Basil Chapman, Tiger Technicians out just during the break. I was doing the Ford chart for those in the den who asked about Ford, and I'll talk about it momentarily. But right now we're on with Mike in New York, and we're looking at RCL. Now, RCL really had I was very impressed with the move from about May of this past year, right through the summer into last month, where it went from, the last big move was from a trough on the 22.12, the week of the 8th of June this year, and it went all the way to last week. Last week we went to 36.18. I mean, that is a huge move. And that's saying that people were spending money. I mean, that's just all there is to it. And the big move going into from the 2009 low of, what was it, so low, right, 550, went all the way to 49.99. So that's it's about, what is that, tenfold increase. So now it's making a pattern that says, okay, I've started to rally in the monthly chart. The MACD's at 84%. The stochastic's looking okay. But it's really the weekly chart that says, watch this closely. So what I'm going to recommend, are you short already?
Not really.
Okay. The candle that I'm looking at is the long-legged doji of the 20th of December, where it went to 34.68 high and closed. It went to 34.08 low and closed near the low. That candle, that body of the candle, not the wick, but the body, says in this particular pattern, it's going to be retested a few times before it decisively breaks one way or the other. And in this particular instance, it did exactly that. The body is between 34.40 and 34.57, and lo and behold, on the 21st, it went to 34.68, even though it was a down day. It was a very ugly day on the 24th, and it still tested the 34.45. Now it's said goodbye to that. So my rule of thumb is with the long-legged doji that we've got to be careful because, first of all, once the trend is ignited and it's a continuation pattern from the last high, and that last high was peak D. Once again, went to both a peak F and a peak D in this particular chart. 36.18 was the high of the 19th. It says there's a really good chance it's going to test the low of the 16th, which is at 32.83. But I've drawn the support bar all the way to 32.63, the low of the 25th, where it gapped up on some kind of news between the 24th and 25th. So my target here is that within, by the very first or second trading day of January, that's by Tuesday, Wednesday, we should see a test of the somewhere close to the 32.83 level, which is about 60 cents lower than it's at right now. If it takes that out, then the gap is likely to be filled. I have a target for this sometime in January if it doesn't push above 34.70. I have a target for this going below 32. And the moment it goes below 32 and it completely fills in the gap of 31.40, which is the gap of the 24th, that was the high, I think this is going down to the 200-period moving average of 30.17. It has held well. The week has only started, so the MACD hasn't turned down. That's why I'm saying I have to give it a little time. Most importantly, what I'm looking at is that the stochastics at 79 and turning down really sharply. The beta, the distance between the fast-moving average and the slow-moving average, is very sharp. So I see very limited upside action. I do see quite a bit of downside action. Big test is going to come if it cracks. If it closes under 31.40, 31.30, it's going to be a real quick drop to 30.17. So I would start a small short right here if you haven't already, and I'd put a stop on this position. I'd make it a wider stop. I'd make it above the candle high of Monday of 34.45. 34.45. Yeah, I'd actually give it about 1.5 points in a small position. I would then add to this position if today closes underneath 33.38 is the low. If it closes under 33.20, I'd add another small position. That one has to have a much tighter stop of about 60 to 80 cents. Hope that helps you.
Yeah, one more question on the Herbalife. Yes. How do you arrive at the 21 target? Is that a left side, right side?
Oh, that 21.52 is a 200-period moving average, and it's proof that it likes to test that level, likes to test it. It's done it once way back when it opened back in April of 2005, and it did it throughout the whole period going into the 2009 January rally that started. So that, to me, is it just visually.
That's on the monthly.
That's the monthly chart. But the MACD and stochastic are terrible. So they can come out with news right now. I know they're having conferences. I've spoken about this many times about Herbalife. Why I wanted to short it was for the very reason that it seemed to me, I didn't have any facts, but it seemed to me it was based on some kind of a pyramid scheme. I have no idea if that's true. That's what's being claimed. But the chart itself said, whoa, be careful. That big drop from the 73 round number high, peak D in the weekly, peak G in the monthly with the doji high, and it turns out to be a peak D, I believe, in the daily. That's a beautiful pattern. That's a couple. That's a double top, what I call the drop bucket pattern. If anyone looks at the high that was going to the high of the 23rd of April, that's this pattern that I talk about in great detail in my CD introducing the ChapmanWave methodology, is a double top formation. That's not good enough just to recognize it. If you recognize it and add the two technicals, the MACD and the slow stochastic, and you get that failure of the technicals to confirm the rally at that double top, it's like the inverted dreaded H, lowercase h, that is so positive when the right side tests successfully with the technicals improving. This is the exact opposite. It failed. So that's one of the patterns in my ChapmanWave CD introducing the ChapmanWave methodology I talk about. It is the drop bucket formation. It's just a double top formation, and I don't want to go into the reasons why it's a drop bucket, but that's good enough for me, and that's exactly what happened. And look at the plunge. So that's Herbalife. Thanks so much for calling, Mike. Happy New Year.
Yeah, you too. Thank you, Basil.
Thank you very much. Let's go to Mike in Ormond Beach. We're going all the way down south now. Hi, Mike. How are you?
Pretty good. I'm the southern Mike.
You're the southern Mike. Yep, the north, the North Pole, the South Pole. Yes.
Yeah.
So,
hey, Basil, on last week we talked about the Dow and the daily confirming a peak F.
Yes.
With going below 13,118, I think you said.
Yes.
In the daily, and I wanted you to confirm where we are in the longer term charts, meaning the weekly and the monthly. And I know many times you brought up about fundamentally with all the art, big art.
Oh yeah, all the socioeconomic aspect, the artistic,
and the construction with the skyscrapers and all these big, milestones.
Huge, yes.
Where do you think we are with the markets to where we could possibly have a long-term downtrend?
Well, I'm actually putting something together. I just don't know. I'm hoping to go and visit the grandkids this coming weekend, so I just don't know how I'm going to do it. But at the end, I've already started putting the chart. I've done almost all the work. I just have to write it up. I'm trying to put together the whole concept as I wrote in the 1986-87 paper that I did, that Barron's was going to present, and then it was just way too bullish. And 1986-87. Mm-hmm. And wait. When was the big crash? 1978, 79. Okay, so I can't even remember now. It's so long ago. Anyway, the paper that I wrote, yes, that's right. In 87, 80, I did that again. So then I put it into this form of a paper, which is part. You can go to the front page of TFNN, go to Education University, I think, and you'll see the chapter from the book is excerpted there. And I put together this whole thing about talking about the mega cruise ships that were like islands by themselves, that had fire departments, they had police. It was unbelievable. They were concepts, and then all of a sudden, as they came about, and I also wrote about standard cars that you could buy that were just standard cars that you could get them from a showroom floor. That I'm not talking about price. I'm talking about the actual cars that would be cruising at over 200 miles an hour,
right.
And that all would fit together with what we were looking at in terms of the mega move. Well, I've slowly been piecing together this whole thing, and it seems to me that no matter how I slice it, we are in a huge bubble of excessivity, I call it. It's not really a word, I made it up, but it fits exactly. It's excessivity. And slowly but surely, one by one, it's being chipped away by other forces. The most important is that I don't know yet whether I'm ready to do it, but I'm on the verge of talking about capitalism. And I'd spoken about this before. Reagan said, tear down your wall, Mr. Gorbachev, I think it was. And I spoke about us exporting capitalism and importing socialism. I spoke about most countries around the world wanting to buy American. So there's a big dichotomy, because if we are starting to sell cars, etc., to China and to India and to all these other countries, is that going to ameliorate a really bad economic cycle? Well, this is what I'm trying to gather, but all the other aspects, right to this guy, I got his name somewhere here, who was talking just there about a week ago, talking about the yards. What was it? I've got it written down. I'll probably find. I always write these things down. He was talking about this huge project in New York that was going to be, they've already bought the land. It's just the biggest land purchase. It's one of the biggest projects they've ever had. And it's one of the yards, one of the shipyards. It's called, so I'll find it. It's here somewhere. Everything there says that we are headed towards this period of excessivity that is going to, whenever the pendulum swings, it always swings from, especially in America, it swings from excessivity to ascetic, to nothing. We go to bare bones. And we haven't yet had that cycle to bare bones. Even the huge drop of 51% in the S&P was met with real estate going to new highs. So as long as we keep rotating, it's when all of that is done. So I'm putting together, and my suspicion is that the big clue is going to come when Brooklyn finally gets so overheated that you get an announcement of some incredible something or other in Brooklyn, and that basically spells a top of pretty good significance. Whether we rotate through and we muddle through in a long period between, and I'm showing the Dow chart right now, I'm going to show it because this is part of your question. I'm going to show the S&P because I've done more work on this in terms of the putting it on the white background chart. The S&P monthly chart right now, oops, wrong one, that I'm showing, Tiger TV, and I'm going to talk a lot more about it tomorrow as we get closer to the end of the year, shows a trading range is possible, just as the Dow had a trading range of, let's call it, between, I'm doing it off the top of my head, I think it was the 600s and the 1000s in the Dow back in 1965 to 60. I could get all those numbers exact until it broke out when Nixon was president, above 1,000. Well, I suspect that there's a chance that we could have some great news that comes along. We have this burst of upside activity, but the S&P resistance between 1471 and 1576 is huge, as I see it. So that says the upside is probably limited to 1,000 points in the Dow, 100 points on the S&P. I'm just giving the most optimistic right now. As I'm seeing it, I might modify that, but that's what I'm looking at. And there's tremendous support. And until that S&P chart that I usually talk about, let me find it right here, the monthly chart right there, we have still not decisively broken to make the down channel a viable entity in the chart that I'm showing right now with the black background. So if the S&P is able to squeak to a decent close in December, somewhere into the 1428 levels, just maybe another 10 points higher, but moving to the right, it says that the chart that I've drawn, not the anticipated, but the chart pattern that was showing itself as possible will become moot, and the up channel, which is still intact, will remain in place. So that's what I'm looking at. So how do I put the picture together? Those are the things that it'll probably take me a little while. Probably I'm going to take most of January to put it together. But so far, my eye says that bonds, if bonds are going to be held up, that's one thing. If I had a major sell signal in bonds, then I would say, you know what, that money is going to come right into the stock market. It has traditionally done that. We've never had a major top without the majority of people in stocks. Majority of people are out of stocks. That would take not just 3 months, which is usually how you make significant tops after people recognize the market is going higher. That would take months. It could be an entire year of moving higher. If I had a sell signal in bonds that said yields are going to go high, much higher, the only way people feel they're going to make money is to actually put money back into stocks. I don't see that. So as we go to a break, let me just say, I'm going to make the levels on the S&P very clear. In January, if the S&P breaks 1343, I'd even say 1358, but 1358 to 1343, be careful, we're going down really sharply. If it meanders here and it can squeak higher and make a new high above 1474, that's going to be positive for you.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi, folks. I had a question, which I think is a good question. First of all, it was Hudson Yards that was discussed, and I can't remember. I wrote it down very quickly, so I can't read my handwriting who it was. Talking about that they had bought the 26 acres in Manhattan. 26 acres! I'll say that again. This is Manhattan. So it's 7.3 miles or something by 3.5. A group bought 26 acres that they are redoing. Now, in the long term, that is incredible. That's fantastic. That's what makes a city last another 100 years. It's really important to be able to do that. In the shorter term, that's a signal to me that's, you've got to be careful. It could be some kind of a top. Now, the reason why I spoke about Brooklyn is because during the debacle, the housing debacle, I was looking at property throughout to the 2004, 5, 6, 7, 8, 9 period. I watched that property real closely, and it held very, very well. Very well, I should say. And yes, there were areas that were just not good at all. But I'm talking about areas of Brooklyn and Williamsburg, etc., that have found popularity amongst the young set, just as many areas in the 1920s found. Just as big developments were made. Funnily enough, I just found right here at Newton City Hall on Monday, I went there for a particular reason, that this whole area that I'm in right now, West Newton Hill, Beaumont Estates it was called, it was subdivided in 1926. So these big developments are done just in certain periods of time. There's just an opportune time, and that's when it is. And there are bidding wars going on in Brooklyn, and I suspect because it's in a sense it's like the pinnacle. Manhattan, Brooklyn is the pinnacle of what's been going on. They've got this fantastic waterfront walkway. There are really big positives in the long term. I'm going to see how this is working out in the shorter term, because I suspect that when I get there to see that announcement of some major, I'm talking about really big, someone steps up and says, I'm going to hit this out of the park and I'm going to make a bundle, and I'm going to buy and build the tallest or biggest, widest, or whatever it is, or overlapping the river by 500 feet and a mile in the sky, whatever it is. That's going to be the sign that says, watch out. And we haven't quite got there yet. So I'm watching. I'm only looking at numbers. Yes, and let me just say, why is Ford acting so well? I mean, they've been lambasted in the Consumer Report for their electronic system, for the voice system, and other things, and yet they're doing so well. There's a leg E up in the weekly chart. It's got strong resistance at the 1305 level. Why is General Motors up right now? It's unchanged. It's at 2765. But it's right at the 200 period exponential moving average in the weekly chart. So we are getting signs that say, some stocks have done very, very well. Why? Why is Toll Brothers acting so well? It's up, it's pulled back, but it's done. Look at the monthly chart. That is a spectacular move. I think what I'm going to do is I'm going to spend time today, and I will start discussing this tomorrow. Tomorrow will be the session. It'll be a quiet day. I'm going to go into it in much greater detail. I'll talk about the home builders, the automobiles, maybe steel, put these all together, interest rates. I'll try to get a package together that I'm at least starting to make sense for myself, hopefully for you as well. So do I hear the music? Do I hear the music there? No, I don't hear the music. Okay.
Hey, Basil?
So, yes.
Well, one thing I'd like to add, I remember John Bollinger, who developed the Bollinger Bands, was a guest on Tom's show about 9 or 10 years ago.
I remember it well, yes.
And his interview, I've got notes on it. He predicted that we'd be in a huge trading range for like 10 to 15 years, with the bottom of the S&P being around the 700 area, 750,
wow,
and the top being around 1,500.
You know, I forgot the numbers. I do remember it, but thanks for bringing up those numbers again.
Yeah.
I can see something like that as a possibility. So I'm going to talk a lot more about it tomorrow. I'm going to give parameters, what I'm looking at, and why I'm looking at it. Thanks so much for calling, Mike.
Looking for a